Today we're going to talk about the differences between day trading, investing, or retirement, your 401k or Roth, IRA, etc. Um, what are the differences and what might be right for you? So we're going to start with day trading. Uh, Pros and cons. So day trading is when you're getting into the positions in and out pretty quickly. So that's maybe within minutes, hours, maybe within a couple days. But you're definitely not talking about trading a 6 month position or year or anything longer than that. So for the pros, we'll start with more consistent, right? So you can go into a day trade every day planning for a certain amount you want to make, where you can just open and close that trade. Let's say you want to make $200 a day, $300 a day, etc. Whereas if you're comparing that to investing, you might be sitting in that position and maybe over a couple of years you want to make 50% of your account or 100%. But at any time during that point, maybe you're going to be down 20%, down 30%, and your account value is just going up and down over the months, weeks, years, whatever that is. So with day trading, you can either just take that small amount every day to kind of more guarantee yourself your account value, and it's a little bit more consistent for your income as well, if that's what you're planning to do. So second, when you're day trading, your money's always going to be in that account, and if you need to take it out, at least you're not cutting yourself out of a position. So we'll just say you bought $20,000 of AMC, right? You were looking for that thing to go crazy, right, to the moon. And let's say AMC is down from 25 to maybe $10. Your 20 grand sitting at 8 grand, 9 grand. And what if you need to take that money out? Well, you needed that 15, 20 grand for something else, an investment, emergency. And if you have to close that position to take the money out, that's all you're left with. And if you're going to use that money or put it back in, you're not going to get in exactly the same place you were when you took it out. So that if you were day trading, you're typically not going to be stuck in a position for very long. So your account is always going to be there. You can always take that money out, put it back in when you need to, and then start your trading again. So for the next pro, so with your compounding growth, basically, if you're trading with, we'll say 20K, maybe your monthly gain you made that account to 23K. Now you're trading with a slightly larger account. That same trade you made with the same percentage gain the next month, instead of the 3,000 gain, that might get you to maybe 28K. You take the same trade you did with the same percentage again, but now you're using with a larger account. You might be compounding that to 34 grand, and so on and so forth. So since you're able to take those smaller trades and keep adding them into the account, every time you go into another trade, you can take a bigger position and get you a bigger percentage gain, even though it's the same trade you might have made with that smaller size. So for our cons for day trading, more risky. But that also goes with depending what you're going to be trading too. So if you're looking to trade the penny stocks, of course you have the potential to lose 50% in a day, even 80% in a day, as some pretty crazy price swings. Same thing, you could be gaining 50% in a day, 80%. And I've done it myself. It's possible, but the risks are always there. And that depends on how much are you willing to risk. Is that money something that you can live without? Is it extra money? Is that money you absolutely need and you just want to grow it? That's probably something you want to steer away from. Whereas if it was money that I needed, that's not something I would trade, but of course that's with your own risk tolerance. So, time to grab. If you're day trading, you're going to be looking more at the charts to find better entries, exits, planning them. Whereas if you were just going to invest, you're probably just going to buy that stock and let it sit, maybe check on it every week, every couple days or so, but you're not going to be sitting there every day looking for crucial entries, exits, and oh, I'm already up 200-300, let me close that trade, open another one for the next day. So a little bit more time consuming, right? So for the next. So you can lose money when the market goes up or when the market goes down. If you take your trade in terrible places without looking at your trading range, without looking maybe at resistance and supports, you might be buying at the wrong place. Even though the stock has been going up, you might have bought at the top, and then it decides to drop, and then all you're looking at is just negative, negative, negative every day while you're holding that position. And your emotions are the only thing that causes problem, right? If you see your account that's already negative 20%, negative 30%, you're probably going to want to close that out or say, what the hell did I do that for? You know, and that can make you close your position because maybe you didn't plan for that much of a drop, and it might still go back up next month or two, but maybe you just bought at the wrong time. And once again, that goes either way. Maybe you could have shorted something that's going up and it keeps going up, and you're freaking out now because your account is, once again, negative 20%, negative 30%, and you're scared, you're angry, you're like, what if I lose everything? And you close that trade and then it ends up going the other way. Where compared to investing, if you bought at the worst place and you're down 40-50%, and if you still have that long-term plan, well, this stock is probably going to turn around 6 months or a year from now, and I'm okay with waiting for that. And that'd be the big difference between day trading and investing there. Alright, so now we're going to talk about investing. So, over the long term, you almost always win. So this applies if you're trading any decent companies or companies that might have a good outlook in the future. This might not exactly apply to penny stocks. penny stocks are gonna be your long shots, right? Your let's say your account value is 10 grand. The best way to invest that to get a bit of both is you probably want to put your biggest chunk, let's say 8 grand, into the large caps. And what you want to do with the smaller portion is maybe with the 2 grand or possibly even less, maybe 1 grand for your risky trades. So that's going to be your GameStop, your AMC, your biopharmaceutical companies, the marijuana stocks, etc. You know, whatever's trending and you're looking for that crazy gain, that's where you want to keep the smaller trades in. And with that 2 grand doesn't mean put it all in one stock. You still want to separate those. So if that one thing goes down and another one is going up at the same time, at least you have a bit of balance and one stock can't take a big chunk down for longer term investing. Because with the almost always win, if you have that 8 grand in good stocks, you know, something bigger, Apple, Microsoft, Google, Amazon, or the indexes, S&P 500, NASDAQ, etc. Those over the long term, you know, 6 months, a year from now, they're probably not closing down. I don't think Amazon's going anywhere anytime soon. They're gonna keep growing. Everybody's using them, just like any of the other big companies. Apple, I don't think they're going anywhere anytime soon, and they just keep growing, right? Okay, for the next. You don't have to sit down, take the time to search for your trades. You can, like I said, just find a decent place to take that position and let it ride. Check it every week, every couple days, months from now. And what you can also do is also with your 8 grand, if you're splitting your account like that, you also don't want to put that all in one company, and also don't put it all in at once. Buy a little bit, and if the stock goes up, great, leave it there. If the stock goes down, at least you have extra in your account to buy some more of that position at a lower price so you can get a better average. And I'll probably show you a graph of a good way to do that later as well. So next we're looking at perfect entry isn't important. Compared to your day trade, kind of also relating to not having to search for your trades, but since you don't need a perfect entry because maybe over 36 months from now, that little bit of a bad entry you took is probably still going to have a better outcome over the long run, where let's say you bought Apple at $35, just an example, and the next day it dropped to 30. So your 35 position looks shitty at that time, but if you're planning for that stock to go to 60 in the next year, that 30 to 35 drop didn't really make a big difference for you. And even that drop from 35 to 30, if you kept open room in your account, that's another opportunity for you to add to your account and bring your average price down to buy some more at that lower price whenever it drops. And last for the pros, dividends. So if you're holding profitable companies, just like what I mentioned, Google, Apple, Microsoft, etc., they pay out dividends if they're making profits. So for every share that you hold, they pay you a small percentage, and you get that every quarter, so 4 times a year. If you've been holding that stock long term, you're collecting the gains for that stock plus the dividends, and they'll pay you that out for anybody who's been a shareholder through that period of time. And go into the cons now. Money. Money's tied up. So, just like I was saying, for that position you took, let's say it dropped from 35 to 30 or 35 to 25. Now your accounts took a big dive. And once again, if you needed that money to use for something, it's stuck there, because if you take it out, you took that 40% loss, 30% loss, and once you took that money out, if it goes up without you, you're not getting it back. So not the greatest for people who needed that money that they were investing with. And long-term investment enough to retire. So let's say you were able to put 20,000 in your investment. A good balanced portfolio over that portfolio's lifetime, if you're gonna say maybe 10 years, 20 years, if you left that money in, you've just been letting it grow, right? A good balanced portfolio, you should be able to at least get a couple 100%, right? Over the course of that investment's lifetime. So you're looking at 200-300%. So if you had that 25 grand and you let that amount sit, let's just say you didn't add to this, right? That was just money you put away and you're letting it grow. So 25 grand, 200%. Okay, so you got to 75 grand because that 25 grand was just sitting there. So you didn't add to it, change it, you didn't buy more. So it's at 75 or 100 grand. So you made a good gain over your lifetime of that investment, but is that enough for you to retire with? Was the money you put away, even if you had a good portfolio, enough for you to end up with enough to make a difference for whatever you're trying to do? It may be for you, depending on how much you put away. Maybe you had more money and you put 250 grand in that account because you had a ton of money saved up and you're letting that investment sit long term. That 250 grand could be $1 million by the time you're done with that good balanced portfolio. So this is kind of your general investment. This is where most people are invested in. Your 401ks, your IRS. That's most of your jobs are probably offer this. That's the money you put away each paycheck. Over the long term, you let that sit in an account and you keep contributing each paycheck and you let it grow, right? So the reason that those are for the general public, right? They're long-term, they're guaranteed returns. So that money is not gonna just disappear. It's usually also well balanced, managed by some company. And over the long term, you're gonna get a consistent, I'd probably say after the fees, which we're going to talk about, which are you're probably going to get 3 to 5% per year, right? Maybe 8% average if the market's been really good. If we're still continuing in a good bull market, continuing over next 10, 20 years. So those are more for people that don't want to do their own investing. It probably scares you, or you think that you might lose everything you have and you're just afraid to get into it. And it's not terrible, because if you do it right, you can make those work too. And it's great because it's something you can keep adding into without even knowing. So the next one can be taken right out of paycheck. So that avoids you putting money in, that avoids you taking a trade, that avoids you having to look for trades. It just leaves you not having to worry about it, right? We have, so a lot of your companies also might have an employer match. So let's say you put in $25 per paycheck or $30 per paycheck, whatever. A lot of companies will offer a match up to maybe a percentage of your paycheck or a dollar amount. So we'll say maybe a general amount of 5% of your paycheck. You put in $30 and your employer puts in a $30 with yours and goes in the same paycheck. So that can be an advantage to also take extra money and keep compounding that as well. Because that money's helping you, right? It's not your money, but it's going towards your retirement. And then we're going to start with the cons here. So returns may not be enough, and that's going to go along with high fees. So these companies that are managing this for you, and I've looked a little bit in depth into this, so they're going to have an annual fee, which you're probably going to be looking at maybe 1 to 2% from your account value is going to be taken just for them to just a fee for you having it in their account, right? And then you're going to have an account management fee, which might be another 0.3 to 0.8%, and that's for the person that's handling the account. So that would be the person who's maybe managing where that money's going, managing what fund it's being invested in, or how it's balanced, etc., or managing how often it's, maybe changing the investment to something else, whether it's high risk, low risk. This would just be more of a generic average number with a safer return, because there are more risky ones as well that might get you a bit better gains. But if you're adding in the fees, which another one I've looked at is transaction fees. So let's say you get your paycheck every week, and every week another contribution goes into your 401k account. So they will also charge a transaction fee on top of that annual fee and on top of the management fee. And that's going to be a fee per week, or per your paycheck, or however often they're putting it in, but it's definitely going to be every time your money goes in. They charge you a fee for placing that transaction that, let's say your $30 went in this week. They're charging you a fee on that $30 to buy the stock or whatever fund it's invested in to buy another share. And if you keep adding that up, let's say the market is supposed to return you 8% average per year, that's probably what you're going to be left with after your 8%. They're going to take a good chunk of it, right? So, going again, is that really enough for you? Are you putting enough away to make use of that? Because if you only put away 25 grand, 30 grand, 35% per year, it's not going to grow very much by the time you're at your retirement age, which leads into the next one. You can't use that money until you're at your retirement age, which is about 55, where you can start taking it out. And I think taking it out completely is still a bit above that, but once again, that's not money you can take out, not money you can use, or else you're going to be a high percentage fees taken out for withdrawing early. And if you didn't put that much away, is that 35% going to set you up for retirement by the time you're done? In my case, I wouldn't think so, but that depends on how much you put away, how much you're saving, and what your goals are for your retirement. Alright, so now we're going to talk about my suggestion, which I think maybe for my personal goals, this is my best approach. Might be different for you, but I'm looking for much bigger gains than letting something sit and invest on its own, or a 401k IRA with so many fees. So my suggestion would be to do a balance of day trading and investing. So even with a minimum, like I said, with the 2,000 to 4,000, you can still day trade and you can still invest. These are some micro futures, which on TD Ameritrade you're going to see them look like this on the ticker symbols. This is micros for the S&P 500, which is basically a fraction. Like if you were buying a fraction of Bitcoin, you're not paying whatever $50,000 for one Bitcoin is right now. You're maybe only buying a couple $100 of Bitcoin or 1,000 of Bitcoin. You're buying just a fraction of it because you don't have enough to buy a whole one to ride the gains, right? So even with a micro worth $1,200, every 25-cent move on the S&P gains you $1.25. So let's say you bought, if you compare $1,200 to stock, let's say you bought $1,200 of whatever stock, Apple, and that stock moves a couple, every cent literally gains you that cent that it moves. If that gains 25 cents with one share, you're only gaining that 25 cents. So it's not giving you much. Whereas doing with your small account futures is going to get you a much bigger gain. And this one we have is gold. And this is wheat. Kind of a much bigger gain you can get with a smaller margin here. And there are other futures like that as well. This is just a sample one, which is for pretty only $2,000. Every 25-cent move can get you $12.50. It's pretty big for a small size account to do something like that. So my suggestion would be is if you only have a couple thousand that you want to grow, would be to put most of it to trade with, maybe 3,000 or so, or 3,500 you want to keep for your trading, and then leave that little bit of rest that you have, whatever it may be, $100 to $500. You can put those in the riskier stocks, something that's small cap, penny stocks, like we were talking about, the marijuana stocks or crypto, something that might be a longer term. You might not make a big amount right away, but maybe over 6 months, a year, a couple of years, that small amount might double, triple, 100 times whatever you put in. And at least if it doesn't work out, you didn't lose the chance to, let's say if you had 4,000 and you put the whole 4,000 in Dogecoin, right? Something like that. And that thing's sitting at 5 cents, 6 cents for the next 6 months. And for the next 6 months, you didn't make any money because that money's stuck there. And you're down on that position. And for 6 months that you could have been trading, doubling your account, maybe every couple of months or so, you're sitting there with the same account because you put all of it in something, and you put all of it in something that was risky. You might even lose most of what you put in. So, kind of a trade example of what I would do, we'll take S&P 500 for example, as that's one of my favorite ones to trade. It's gone up for the last, basically ever since the S&P 500 has been there. It's the top 500 companies, right, in the US. An index that's well balanced of all areas of the market. So let's say you were looking to take a trade for something like that. This is kind of a graph of the market, where it was, and let's say you still had not much of an idea of what you're doing, you wanted to jump in, and you bought it right here. Okay? So that's your position. You bought it on the way up. And then this is March. We had this massive crash, right? The S&P 500 was, let's say, around 33.81. That was the price there, right? Let's say this is where it bottomed out. Let's say 21.74. Now let's say you were the jackass that bought in the worst possible place on this chart, right? You bought right at the top. So let's say you had that 4,000 and you bought one position with your 1,200, and you're writing it down. And maybe you had a little bit extra because you didn't go all in. So what you could do, even on the way down for something like this is your current position. If you were to buy another one here, let's say on its way down, you just brought your average position is now here, but it's still going down. Let's say you waited this time and you're like, okay, I want to get a better position, get a better average. So you bought, started going back up. Let's say you bought another one. The market finally bottomed out. You're like, okay, I can get a better position here now. So you got your average down from there to here because you bought a third share of that micro, and your average is now right here. So anywhere from here, you're now negative or positive once that gets there. So climb back up, did some of this, and now we're just ripping right here, right? And even if you only bought that one position at 33.81, this still would have sucked to hold through that. But what you could have done with your trading was average down for a better position. And this is just worst case. Let's say you were the person that bought in the worst possible place, and instead of taking a loss for something that was consistent, because if this was a penny stock, a small cap, you would have been done. This probably would have never come back. It would have went to 5 cents from $50, $100, and the company might even close down, whatever it was. You have no hope after that because you put it in something risky. But something like one of the market indexes, whenever we have a crash or a bear market, there's always going to be a few months, 6 months, a year, etc. That thing's going to come back eventually, but even in that time, you can build yourself a better, this might be more of a medium-term position than short-term, but now with your average here, even if you only got your 3 of these positions, that would have been a $3,600 investment, and it would have netted you an average position of, we'll say, around, just a random guess, of 2,600. And now we're at around 3950. So with your 3,600, since you now have 3 of these, every 25-cent move is now 375. So from your average position all the way down here, because you build your position instead of going all in, up at 3950, you would be up roughly 20,385 with your 3,600. And you didn't have to do it with a penny stock. You didn't have to do it with something crazy like one of the cryptocurrencies that may or may not ever get anywhere. You know, other than Bitcoin is kind of already taken off and it's pretty expensive to get into, right? So this is an example of what I would do to trade with something consistent, but if you have a smaller account. Of course, if your account was bigger, we'd be talking bigger numbers here, bigger numbers there. But for a lot of people, maybe this is all we can get together and that's all you can trade with. You can still make money. That's a huge number going from your $3,600 investment. So if it were me, this is kind of more what I'd be looking to do. And I'm going to be putting together some more videos of how I might more manage this, or how I might be actually taking entries, exits. I would hope to never be in something this long term, but still you can. Maybe that's something that you might want to do. And this is something maybe you also didn't consider before. Because if you're looking to make 20 grand out of your 3 grand, you're probably looking to toss it into something crazy, something you heard on the news, GameStop, AMC, and whatever it is. But there's other ways too that are a little bit more consistent and less risky. So you can consider the options for what we have for day trading, investing, or go on the road of the 401k IRA, which you probably already are, through your company, your work, whatever, and find out which one's better for you. And any questions, put it in the comments. Please like and subscribe so I can get more videos out to you guys. And any questions, I'll go ahead and answer. And also, if you guys want to see something specific, please leave that in the comments too, so I can make a video for maybe whatever questions you have. Alright, thanks.